This is an example of a MacD buy setup, what we call MacD positive divergence. See, normally as price goes down, so does MacD. But sometimes price will go down, but the MacD won't follow, and this is where you want to pay attention. Now again, this could be on any time frame, but the idea is that we get positive divergence, and this is important, once price has hit a major key level on a higher time frame. Just remember that. What we want to see happen is that we have lower swing lows being made on the price chart, but on the MacD indicator, the corresponding lows are moving higher, not lower. Okay, see this A goes down to B, the price is going lower, but if you look at the corresponding lows on the MacD, the wave bottoms on the MacD are actually moving higher. Okay, you'll notice here, by the way, that these don't correspond exactly, and that's because MacD is a lagging indicator. So I wanted to show you what it looks like in actual reality. They don't exactly match up. They're offset a little bit because of the lagging factor. And this all has to happen with price hitting, like I said before, a key level of support on a higher time frame, and then the price starts to rally up after that. Okay, and then what has to happen? We need to see price rally up and retest what we call the neckline, which is the highest high made between the swing lows. So between A and B, this was the highest high right here, right? And we need to see that get retested before we even consider taking a trade. Okay, now in reality, I use the highest closing body of a candlestick, okay, not the top of the wick. So I just need to see price come up and retest the top, the highest closing body, and that's good enough for me. I've just noticed that quite often price will make it to the highest body and not make it to the wick, so that works really well. But you know, if it goes beyond, that's just fine too. So after the neckline is retested up here, then we look to be a buyer as price comes down to either the 62% fib or the 79% fib, just like in a noble entry. Now, obviously, the 79% level is better in terms of less risk because the stop is always going to be below point B here. You see that? But the flip side is if you wait for 79%, you could miss the trade if it stops at 62%. Okay, so that can happen because what it'll simply do quite often is it'll go down and it will see this, what we call the left shoulder here. It'll actually come down and just hit that left shoulder and bounce up sometimes too. And we would actually call this an inverted head and shoulders pattern technically, but to us it's just a MacD positive divergence trade. If this was a higher time frame like an hourly or a 4-hour, you could wait for a noble entry to form over here rather than trying to decide whether to buy it at 62 or 79%. Plus on a higher time frame, the stop needs to go a lot more pips away when it goes below point B here, right? Especially if you want to buy at the 62% level, and that's why it's best to use the noble entry. Like everything else in this course, don't try to do everything and get all confused. Okay, pick one way of doing it and stick with it. Okay, so for this pattern, if you're unsure, then just go for the 79% fib for now, which will give you the lowest amount of pip risk when you put your stop below point B. And so the entry is 62 to 79% pullback for profit for your entry. And before we leave this, I'll just say one thing. Sometimes you'll find that if you buy it at 62% and your stop goes below point B, that the risk in that will be 20 pips or less, and that's fine. I will then usually take it at 62% rather than risk missing it by waiting for 79%. So you have to just have a look at it and see if that would work or not. But if you're unsure, go for the 79%, put your stop below point B. For your profit targets, as we've described earlier in the course, look for the classics, A, B, or C, depending on the volatility of the pair. Another great place to take profits, I would really recommend that you make sure you do this, is at the high that's made after the neckline is retested. See here, so point C, and I would use the high of the highest body here for taking a profit, right in there. Check for pivots too. There might be a pivot right in this level here that might make more sense to take a profit at as well. So you don't have to go for the very last pip every time here. Okay, beyond this level here, look at resistance levels off the 1-hour chart or higher. Let's assume that this is a 15-minute, or it could even be a 1-hour chart. Look for expected resistance levels on the higher time frames. Also, The 127% Fibonacci extension that you get when you measure the retracement from B up to C. See, we go from B up to C, price comes down, and the extension, the 127% extension of the move from B up to C is also an excellent place to look to take profits as well.